In venture capital, ownership is everything. Unlike traditional businesses, where success is measured by revenue and profit, startups play by a different set of rules. Here, the real currency is equity, who owns what and how that ownership evolves over time. Every funding round, every new hire granted stock options, and every investor entering the picture impacts a startup's cap table, influencing the long-term outcomes for founders and stakeholders alike. For both founders and investors, understanding cap tables and dilution is critical. A well-structured cap table ensures that everyone, founders, employees, and investors, remains motivated as the company scales. But a poorly managed one? That can lead to excessive dilution, misaligned incentives, and even difficulties raising future funding rounds. At its core, a cap table tells the story of a startup's ownership. It lays out who holds shares, how much equity is available, and how ownership changes as the company grows. Think of it as a real-time snapshot of how value is distributed. So, what exactly is a cap table? It's a structured record, usually a spreadsheet or a specialized software platform that tracks ownership in a startup. It includes founder equity, investor shares, employee stock options, and any convertible securities, like safes or convertible notes, that may later turn into equity. At the very beginning, a startup's cap table is simple. Imagine two co-founders splitting ownership, perhaps 50-50 or 60-40ths, with a small portion set aside for an employee stock option pool. But as soon as investors come in, that ownership begins to shift. With each new round of funding, founders give up a portion of their equity in exchange for capital to grow the business. This brings us to one of the most important concepts in venture capital: dilution. Dilution happens every time new shares are issued, reducing the percentage ownership of existing shareholders. This is an inevitable part of raising money. A founder might start off owning 40% of their company, but after bringing in investors, their percentage ownership will shrink even if their total number of shares stays the same. But here's the key: while dilution reduces the percentage a founder owns, it doesn't necessarily mean they're losing value. In fact, if the company grows and its valuation increases, their stake may be worth significantly more in dollar terms than before. Let's break this down with an example. Say a startup begins with 10 million shares, and a founder holds 40%. That's 4 million shares. If the company raises $2 million at a $10 million post-money valuation, new investors receive 2 million shares, bringing the total share count to 12 million. The founder still holds their original 4 million shares, but now, instead of 40%, they own about 33%. Their ownership percentage shrinks, but if the company grows successfully, those 4 million shares could be worth far more in the long run. One of the biggest factors affecting dilution is the option pool. Startups typically set aside 10 to 20% of their equity to offer stock options to employees. This is essential for attracting top talent, but how the option pool is structured makes a big difference. Investors often negotiate to have the option pool included in the pre-money valuation, which means it comes out of the founder's equity rather than theirs. This is where strategic planning is crucial. Founders need to ensure they're setting aside enough to hire great employees without over-diluting themselves too early. As a startup moves through multiple funding rounds, dilution continues to compound. A founder who started with 80% ownership in the early days may end up with just 30% or even less by the time the company reaches Series B or C. But here's the bigger picture. If the company's valuation has grown from a few million to hundreds of millions, that smaller percentage could be worth exponentially more. Managing dilution isn't just about numbers, it has real consequences. Founders who give away too much equity too soon may struggle to stay motivated. Investors may hesitate to get involved if too much of the company has already been sold off. Even employees who were promised valuable stock options may find themselves holding significantly diluted shares, reducing their incentives to stick around. This is why VCs scrutinize cap tables so closely. They want to ensure there's enough equity left for key players and that dilution is being managed in a way that supports the company's long-term growth. Some founders try to avoid early dilution by refusing to take on investors too soon, hoping to maintain a larger ownership stake. But this can also be a mistake. Raising capital at the right time and scaling quickly can often create far more value than holding onto an extra few percentage points of equity. At the end of the day, cap tables and dilution aren't just financial details, they shape the trajectory of a startup's success. The best founders and investors think strategically. They plan ahead, ensuring they understand how dilution will impact future rounds. They structure option pools carefully, making sure they can attract talent without giving away too much. And they negotiate fundraising terms that strike the right balance between raising enough capital to grow while keeping ownership at sustainable levels. There are also powerful tools available, platforms like Carta and Pulley, that help founders track and manage ownership more effectively. Because in startups, equity is the most valuable currency. The key to success isn't just building a great company, it's making sure that when the company scales, founders and investors still hold enough ownership to make the journey worthwhile. Those who manage it wisely, they're the ones who reap the biggest rewards. Cap tables and dilution are fundamental to venture-backed startups, shaping how equity is distributed over time. While dilution reduces ownership percentages, strategic fundraising and company growth can make founder stakes more valuable in the long run. Poorly planned cap tables can demotivate key stakeholders, hinder fundraising, and create structural inefficiencies. Founders and investors who proactively manage ownership, option pools, and fundraising terms position themselves for long-term success, ensuring that when the company scales, they still hold meaningful equity to reap the rewards.